Where is it flowing? Well, it's the old story. It's flowing from west to east. China is continuing to buy. The central banks are continuing to buy. Basically, physical gold is bid only. Not only the central banks, but also sovereign wealth funds in Asia and all the rest of it. And also, quite a lot of the super rich in Asia are accumulating gold. And this is in sharp contrast to the West, where we just sort of shrug our shoulders and say, well, why are they doing it? We are completely clueless about what's going on in the bullion markets. But as far as the East is concerned, they see an increasing need to protect their currencies against an inevitable crisis in the West. And that crisis takes the form of unsustainable government debt, which is leading all G7 countries, with the exception of Germany, into a debt trap. The debt trap comes from two ways. I mean, it's not just the mounting debt. And we had extraordinary deficits for the first 2 months of the US fiscal year. I mean, what, 625 billion or something? I mean, it's just going up and up and up and up and up. As far as the foreigners are concerned, they see this and they see that there is absolutely no reason why they should buy US dollars and treasury debt at anything like these yields. And the problem is that if they hold off and they want even higher yields, it just makes the whole situation even worse. So what do? You get out of dollars, and to get out of dollars, I mean, you don't want to go into another currency because, the dollar is the king rat of currencies, as it were. You're going to go into gold, which is real money, and they understand it's real money. And that's what we've lost sight of in the West. And this is why every time gold rises, there's someone in the West who thinks, I ought to take profits at the Chinese or the Russians or whoever say, thank you very much. So that's basically what's going on. It's the other thing that's extraordinary, which I think I should mention, is the amount of gold and silver that's being stood for delivery on COMEX. I mean, this is a market which, the whole concept of delivery on COMEX wasn't that anybody should actually take delivery, but it was literally to tie an expiring futures contract to the underlying metal price. But I was totting up the figures. I mean, since Thanksgiving, which is 9 sessions ago, 56.46 tons of gold have been stood for delivery, and 1,240.4 tons of silver. I mean, these are huge amounts. Now, we don't know who's actually taking this. Some of it, I guess, is remaining within the COMEX's vaulting system. But these, nonetheless, are huge amounts which are being taken out of the establishment's hands, as it were, and going into other hands.
Alasdair Macleod's insights on the shifting dynamics of the gold and silver markets provide a compelling framework for understanding the larger geopolitical and economic shifts that are reshaping the global financial landscape. As he highlights, the movement of gold from west to east signals not just a regional preference for precious metals, but also a broader acknowledgement of gold's role as real money in a world increasingly dominated by fiat currencies and unsustainable debt. The West's disregard for gold is juxtaposed sharply against the East's strategic accumulation of it. While Western investors see gold as a speculative asset, something to buy when the price is rising and sell when it isn't, Eastern nations and individuals view it as a cornerstone of financial stability. Central banks, sovereign wealth funds, and wealthy private individuals in Asia are all major players in this ongoing transfer of wealth. For them, gold is not merely an investment. It's insurance against the instability of fiat currencies and the fragility of global financial systems. Macleod points out that this strategic buying in the East is driven by the recognition of an impending crisis in the West. The unsustainable government debt levels of G7 nations, exacerbated by rising interest rates, have created a ticking time bomb. In the eyes of Eastern governments and investors, the best way to hedge against the fallout of such a crisis is by holding physical gold. The West's debt problem is not a new story, but the scale of the issue has reached alarming proportions. With the U.S. running a staggering $625 billion deficit in just the first 2 months of its fiscal year, it's clear that the trajectory is unsustainable. Foreign investors who traditionally bought U.S. treasuries are now stepping back, unwilling to accept low yields on a currency that is increasingly seen as vulnerable. This reluctance to hold dollars has significant implications. As Macleod notes, foreign investors are not simply shifting from dollars to other fiat currencies. They are moving into gold, which they recognize as real money. This shift is a powerful indictment of the Western financial system and its reliance on fiat currency, backed by nothing more than government promises. Macleod's discussion of the extraordinary delivery volumes on the COMEX highlights another critical aspect of the story. The COMEX, traditionally a futures market rather than a venue for actual physical delivery, has seen massive amounts of gold and silver being stood for delivery. Since Thanksgiving alone, 56.46 tons of gold and 1,240.4 tons of silver have been delivered. This surge in physical deliveries is unprecedented and suggests a growing lack of confidence in the paper gold and silver markets. Investors are increasingly demanding the real thing, rather than settling for paper contracts that may not be backed by physical metal. This trend could be an early indication of a broader crisis in the gold and silver markets, one where the availability of physical metal becomes a critical issue. Macleod argues that these developments point to a potential squeeze on the establishment players in the gold and silver markets. The massive outflows of physical metal, combined with the growing premiums in the futures market, indicate that the traditional mechanisms for controlling prices may be under strain. If this trend continues, it could lead to a major revaluation of gold and silver prices, driven not by speculative buying, but by a genuine scarcity of physical metal. The parallels to the COVID-era disruptions in the exchange for physical market are striking. During that period, the lack of liquidity and the challenges of moving metal between London and New York created a crisis that resulted in significant losses for some market participants. A similar scenario could be unfolding now, with even greater implications for the global financial system. Gold and silver are more than just commodities. They are lifelines in an increasingly unstable world. For individuals, holding physical gold and silver is a way to protect wealth from the erosion of fiat currencies and the risks of financial market disruptions. For nations, these metals offer a way to hedge against the decline of the dollar and the vulnerabilities of the global financial system. The East's aggressive accumulation of gold and silver reflects a recognition of these realities. While the West continues to view gold as an outdated relic, the East sees it as a cornerstone of financial stability. This divergence in perspectives is reshaping the global gold and silver markets and could have profound implications for the future of money itself.
And also, if you look at the exchange for physical, I mean, some of the numbers going through there are just absolutely enormous. Now, we don't know which way it goes. I mean, exchange for physical can be inward going or inward coming or outward going. But it's a fair bet that we're looking at something which is, I think, likely to be the early indications of a crisis in the market. I have no evidence that that is the case, other than these extraordinary flows. It just reminds me of the situation we had, when we had COVID, everything shut down, and there was an absolute crisis in the exchange for physical market. I think Hong Kong on that market alone. So, you can't have a futures market where these enormous amounts are being drained out of it, of physical, and at the same time, I mean, premiums, on futures compared with physical have been rocketing. I was looking at it earlier this morning. Silver, it's come back a bit because they've bashed the price hugely. I mean, they really have. And a lot of that has been taking the wind, if you like, out of the futures markets. But this morning, there was a premium in the on the silver futures contract of around about 12.5 to 13% over spot. Why is this? I think that the reason is that hedge funds in particular have seen the problems in the market rising. They know that there's a lack of liquidity and all the rest of it. They never take delivery. They never buy the underlying stuff. They only deal in derivatives. So what they're doing is they're buying, they're buying futures, or they have been buying futures, really to put the squeeze, if you like, on the swaps. And it just smells like a bear squeeze. So, but that a lot of that is just sort of deflating the futures. So there are funny things going on, DK, but it looks like the markets are running into difficulties, and I don't mean difficulties leading to lower prices. I mean difficulties meaning that the squeeze on the establishment, I think, is really more intense than you would think.
Alasdair Macleod's analysis delves into the intricate dynamics shaping the global financial system, with gold and silver at the epicenter of a monumental shift. This transformation reflects a collision between the West's reliance on fiat currency and the East's strategic embrace of tangible assets. As the old financial order shows cracks, the role of gold and silver in this evolving landscape becomes ever more critical. The East's strategy to accumulate gold is not just a hedge against economic instability, but a deliberate maneuver to redefine global financial norms. Nations like China, India, and Russia view gold as more than a store of value. It's a tool for asserting sovereignty over their economies. With massive gold purchases and increasing transparency, these nations are signaling a departure from the dollar-dominated financial system. For instance, China has been steadily acquiring gold while underreporting its official reserves. Unofficial estimates suggest that the country's actual holdings are significantly higher than stated. Similarly, Russia has amassed around 12,000 tons of gold across its central bank, wealth funds, and other state reserves. Both nations recognize gold's historical stability and its potential to underpin a new monetary order. India, too, plays a vital role in this paradigm shift. The country's insatiable appetite for gold, both at the individual and state level, reflects a cultural and economic alignment with the intrinsic value of this precious metal. Such demand is instrumental in draining global exchanges of physical gold, tightening supply and amplifying its importance. Beyond central banks, sovereign wealth funds in the East are heavily investing in gold. These funds, representing the financial muscle of their nations, recognize gold's strategic importance in safeguarding wealth against currency devaluation and geopolitical risks. For example, the Chinese government's Belt and Road Initiative, which seeks to create a modern Silk Road, integrates gold into its economic strategy. The initiative's long-term objective is to reduce dependence on the dollar while establishing a trade network anchored by tangible assets like gold. This forward-thinking approach is a direct challenge to the dollar's supremacy and highlights the East's strategic foresight. Macleod's observations about the unprecedented delivery volumes on COMEX underscore the growing stress within Western gold markets. Traditionally, COMEX was a futures market, not designed for large-scale physical delivery. Yet recent trends reveal a dramatic increase in the physical offtake of gold and silver. Since Thanksgiving alone, 56.46 tons of gold and 1,240.4 tons of silver have been stood for delivery, astonishing figures that hint at a seismic shift in market behavior. These deliveries reflect a growing lack of confidence in paper gold. Investors and institutions are demanding the actual metal, bypassing the synthetic instruments that dominate Western markets. This trend could signal an impending reckoning for the Western financial system, where the availability of physical metal may no longer meet demand. The EFP market, which allows traders to swap COMEX futures for physical gold in London, has also seen staggering volumes. While the exact flows are opaque, the sheer magnitude of transactions suggests that significant players are repositioning themselves, possibly in anticipation of a market upheaval. Premiums between futures and spot prices further illustrate the strain. At one point, silver futures traded at a 12.5% to 13% premium over spot prices, an unusually high discrepancy. This indicates difficulties in sourcing physical metal and highlights a broader issue: the potential inadequacy of Western markets to fulfill physical demand. As the dollar's dominance wanes, gold and silver are poised to reclaim their roles as primary stores of value. The East's shift away from the dollar is not just about diversifying reserves, but about challenging the dollar-centric global order. By accumulating gold, these nations are preparing for a financial system less reliant on fiat currencies. This transition has profound implications for the West. The decline in dollar demand will erode its purchasing power, exacerbate inflation, and destabilize economies. In such a scenario, gold and silver, assets immune to inflation and currency devaluation, will become indispensable. Macleod's insights into hedge funds' activities reveal another layer of complexity. These funds, which traditionally operate in the derivative space, are now exploiting the lack of liquidity in the physical market. By buying futures, they're effectively putting pressure on the system, forcing a reevaluation of the relationship between physical and paper markets. The potential for a squeeze on the establishment looms large. If physical supply continues to dwindle, it could trigger a dramatic upward revaluation of gold and silver prices. This shift would not be driven by speculative fervor, but by the fundamental mismatch between supply and demand. In the West, gold is often seen as an archaic relic. However, this perception is beginning to change. As inflation accelerates and the dollar's purchasing power declines, even Western investors are starting to recognize gold's enduring value. This shift in mindset is critical for restoring balance in a financial system that has long been skewed toward fiat currencies. Gold's reclassification as a Tier 1 reserve asset by the Bank for International Settlements, BIS, underscores its importance. This designation places gold on par with cash and government bonds, reaffirming its status as a cornerstone of financial stability. The BIS's decision is not merely symbolic, it reflects a strategic acknowledgement of gold's role in a world grappling with economic uncertainty. While gold often takes center stage, silver's dual role as an industrial and monetary metal makes it equally vital. The demand for silver in technology, renewable energy, and healthcare sectors ensures its long-term relevance. Simultaneously, its historical role as money provides a layer of security against economic volatility. The East's interest in silver is particularly notable. Nations like China and India are not just buying gold, but are also aggressively accumulating silver. This strategy highlights silver's unique position as both a critical industrial material and a monetary asset. Alasdair Macleod's analysis offers a roadmap for navigating the tectonic shifts in the global financial system. The East's strategic accumulation of gold and silver is not just a hedge against Western instability, but a blueprint for a new economic order. For investors, the implications are clear. Gold and silver are no longer optional hedges. They are essential components of a resilient portfolio. As the West grapples with unsustainable debt and declining currencies, these metals offer a lifeline for preserving wealth. The moral of the story is simple yet profound. In a world where fiat currencies are losing credibility, tangible assets like gold and silver are the ultimate arbiters of value. By understanding the forces driving these markets, investors can position themselves to not only weather the storm, but to thrive in the new financial landscape that emerges.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.